The New England Business Group presents It's All About Business. Our presentation today is PreStartup Financials. Welcome to the 5th presentation in the New England Business Group Pre-Startup series. This session will introduce pre-startup and pro forma financials, while the entire 7-presentation series will help you evaluate your business opportunities so that you can reach a go, no-go decision. I am Larry Gable, the President and CEO of the New England Business Group, and I'll be your presenter today. The New England Business Group has crafted the pre-startup process to help the entrepreneur organize thoughts and prioritize activities in order to optimize idea development and research processes leading to the go, no-go decision based on market research. The result is an informed decision process that is geared to the realities of the marketplace. The net effect for the entrepreneur is to have acquired an enhanced information set upon which to build a business plan. The work and effort invested in business research and analysis is not wasted, but rather immediately useful in the development of the business plan. Financial planning is a critical activity for every business, irrespective of its age and size. For our new enterprises, the preparation of financial projections is part of the business planning process. For companies large and small, financial planning forms an integral part of the annual budgeting process and plays an important role in long-term planning, business appraisals, and business growth and development. Central to the task of preparing a set of projections is the construction of a mathematical model to reflect the finances and activities of the business. Sales minus costs equals profits is an example of a very simple model for deriving projected profits from assumptions about future sales and costs. In practice, financial planning models are much more complex, as they must accommodate multiple time periods, that is, months, quarters, and years, and handle potentially hundreds of variables relating to sales and costs, etc. The volume of data mounts up very quickly when each variable is multiplied by the time horizon, for example, by 12 months. Financial models are used to compile forecasts and budgets, to assess possible funding requirements, and to explore the likely financial consequences of alternative funding, marketing, or operational strategies. They can also be used for business planning, raising finance, investment or funding appraisals, financial analysis, corporate planning, and so much more. Used effectively, a financial model can help prevent major planning errors, identify or evaluate opportunities, attract external funding, provide strategic guidance, evaluate financial and development options, and monitor the progress of your business. The Financial Projections module is the 5th of 7 modules. It is designed to help the entrepreneur focus on the financial aspects of the business idea being studied. Part 1 introduces the basic financial and accounting definitions and concepts, and Part 2 introduces business financial statements and presents the fundamental notion of financial projections. Beware of little expenses. A small leak will sink a great ship. A quote by Benjamin Franklin. So let's look at some basic financial concepts. The first is we consider accounting much like a balance beam. When we add to one side, we must add the same amount to the other side. So let's get some basic definitions. Assets, that's something we own. Cash, inventory, buildings, land, and it's something someone else owes us, an account receivable, a loan receivable. A liability represents an obligation, something that we owe to someone else, an account payable or a loan payable. And then there is equity, which is owners or shareholders' investment in ownership of the company. It could be share capital. It is also accumulated income year after year, known as retained earnings. So equity represents ownership. Then there's revenues. That's something that we earn. We sell inventory, charge interest, bill for time worked. There are expenses. When we do something to earn revenue, that is advertising, cost of goods sold, wages, etc. And then there is income, which is revenues less expenses. So there is a mathematical equation which must balance. This is the basic accounting equation, and that is that assets equal liabilities plus owner's equity, or A equals L plus E. So when we look at it on the balance beam, we see the A on the left and the L plus E on the right to maintain the balance. We can rearrange that a little bit and say that owner's equity then is going to equal assets minus liabilities. Now let's look at some accounting terms. An account is a group of items having common characteristics. Types of accounts are asset, liability, income, expense, and equity, and there can be more, but those are the basic ones. And then there is a chart of accounts, which is a list of all accounts used by the business. So businesses will have different sets or charts of accounts depending on how the business is run and a lot of other things. But remember that accounting is the language of business. Knowing the language is critical for success of any business function, because a great deal of business information is communicated using these terms. Once you're familiar with the basic terms, you'll be better prepared to make sense of written reports and better able to communicate with others about the financial information. Some more accounting terms. Here we have the cost of goods sold, that's COGS, and it's a direct expense related to producing the goods sold by a company. Then there's kind of the catch-all generally accepted accounting principles, or GAAP, GAAP, and this is a set of rules and guidelines developed by the accounting industry for companies to follow when reporting financial data. And then there is the concept of present value, and that's the value of how much a future stream of money is worth today. So here let's also differentiate between accounting and bookkeeping. Accounting is a general term that refers to the overall process of tracking your business income and expenses and then using the numbers in various calculations and formulas to answer specific questions about the financial and tax status of your business. And bookkeeping refers to the task of recording the amount, date, and source of all business revenues and expenses. Bookkeeping is essentially the starting point of the accounting process. Only with accurate bookkeeping numbers can meaningful accounting be done. Now let's talk about the bookkeeping systems or accounting systems. There are two basic ones, single entry and double entry. Single entry accounting is a simple form of bookkeeping and accounting in which each financial transaction is recorded with a single entry in a journal or transaction log. The single entry approach contrasts with the double entry bookkeeping and accounting, in which every transaction results in two equal and offsetting entries, one a debit and the other a credit. The single entry approach is very similar to the check register that individuals use to keep track of checks, deposits, and balances for the single checking account. The amount of each cash inflow and outflow is recorded along with the transaction name or description. And a double entry system provides several forms of error checking that are absent in the single entry system. In the double entry system, every financial transaction results in both a debit entry in one account and an equal offsetting credit entry in another account. For any time period, the sum of all debits must equal the sum of all credits. That is, total debits equal total credits. Moreover, a double entry system works so that the balance sheet equation always holds. That is, assets equals liabilities plus equities. So these equations are known as the accounting equation. Any departure from the equalities in a double entry system is a signal that a transaction error has been made somewhere. So let's look at some financial statements. We'll focus on the balance sheet, the income statement, and the statement of cash flows. So the balance sheet tells us how much we have, how much we owe, and how much we're worth. The income statement tells us how much money we made in the period, that is, revenues less expenses. And the statement of cash flows, considering that a business has three types of activities: operating activities, investing activities, and financing activities. And the statement of cash flows shows how much each of these three business activities affected cash during the period. Now let's look a little deeper at the balance sheet. The balance sheet lays out the ending balances in a company's asset, liability, and equity accounts as of the date stated on the report. The most common use of the balance sheet is as the basis for ratio analysis to determine the liquidity of a business. The format of the balance sheet is not mandated by accounting standards, but rather the customary usage. The two most common formats are vertical balance sheet, where all the items are presented down the left side of the page, and the horizontal balance sheet, which you can see on the screen here. The vertical format is easier to use when information is being presented for multiple periods. Now let's look at the income statement. The income statement, also called profit and loss or P&L, is a financial statement that measures a company's financial performance over a specific accounting period. Financial performance is assessed by giving a summary of how the business incurs its revenues and expenses through both operating and non-operating activities. It also shows the net profit or loss incurred over a specific accounting period, typically a fiscal quarter or year. Keep in mind that the income statement shows revenues, expenses, gains, and losses. It does not show cash receipts, that is, money you receive, nor cash disbursements, that is, money you pay out. So here is an example of an income statement. As you can see, it has income at the top, and there can be many more sources of income rather than just services rendered. And then there are the expenses listed underneath that, and at the lower right hand you get a net profit by subtracting the two. The activities of a business. Each business has three types of activity: operating activities, investing activities, and financing activities. Operating activities include the production, sales, and delivery of the company's product, as well as collecting payment from its customers. This could include purchasing raw materials, building inventory, advertising, and shipping the product. Investing activities include the purchase or sales of an asset. That is, assets can be land, building equipment, marketable securities, etc. Loans made to suppliers or received from customers. Payments related to mergers and acquisitions, and dividends received. All of those fall under the investing activities. Then there are the financing activities, which include the inflow of cash from investors, as well as the outflow of cash to shareholders as dividends as the company generates income. Other activities, which impact the long-term liabilities and equity of the company, are also considered financing activities. So let's take a little deeper look at the various activities. So the operating activities, as we said, include production, sales, and delivery of the company's products. They could also include the purchase of raw materials, building inventory, advertising, and products. Then there are the investing activities, which include the purchase and sale of assets, loans made to suppliers or received from customers, and payments related to mergers and acquisitions, and dividends received. Then there are financing activities. These include the inflow of cash from investors as well as the outflow of cash to shareholders. Other activities which impact the long-term liabilities and equity of the company are also considered financing activities. Note here that if the business is a car dealership, most cars would be in inventory and not listed as fixed assets as in other businesses. So let's look at the statement of cash flows. The statement of cash flows is concerned with the flow of cash in and out of the business. The statement captures both the current operating results and the accompanying changes in the balance sheet. As an analytical tool, the statement of cash flows is useful in determining the short-term viability of the company, particularly its ability to pay bills. So we can see that the statement then is consisting of cash from operating activities, cash from investing activities, and cash from financing activities. So here's an example statement of cash flows. So the cash flow statement, or the statement of cash flows, is a financial statement that shows how changes in balance sheet accounts and income affect cash and cash equivalents, and breaks the analysis down into operating, investing, and financing activities. Essentially, the cash flow statement is concerned with the flow of cash in and out of the business. As an analytical tool, the statement of cash flows is useful in determining the short-term viability of a company, particularly the ability to pay bills. The balance sheet is a snapshot of the firm's financial resources and obligations at a single point in time, and the income statement summarizes the firm's financial transactions over an interval of time. But these two statements are used by firms to match revenues with expenses associated with generating those revenues. The cash flow statement then includes only inflows and outflows of cash and cash equivalents. It excludes transactions that do not directly affect cash receipts and payments. These non-cash transactions include depreciation or write-offs on bad debts or credit losses, just to name a few. The cash flow statement is a cash basis report on the three types of activities: operating, investing, and financing. Non-cash activities usually are reported in footnotes rather than in the statement. So the cash flow statement is intended to first provide information on the firm's liquidity and solvency and its ability to change cash flows in future circumstances. It's there to provide additional information for evaluating changes in assets, liabilities, and equities. It can help improve the comparability of different firms' operating performance by eliminating the effects of different accounting methods. It can also indicate the amount, timing, and probability of future cash flows, and with that, cash needs as well. And the cash flow statement has been adopted as a standard financial statement because it eliminates allocations which might be derived from different accounting methods, such as various time frames for depreciating fixed assets. So let's look at some financial projection pieces and implications. So a business plan is all conceptual until you start filling in the numbers and terms. The sections about your marketing plan and strategy are interesting to read, but they don't mean a thing if you can't justify your business with good figures on the bottom line. You do this in a distinct section of your business plan for financial forecasts and statements. The financial section of the business plan is one of the most essential components of the plan, as you will need it if you have any hope of winning over investors or obtaining a bank loan. Even if you don't need financing, you should compile a financial forecast in order to simply be successful in steering your business. The financial projection is what will tell you whether the business will be viable or whether you are wasting your time and money. The purpose of the financial section of the business plan is twofold. You're going to need it if you're seeking investment from venture capitalists, angel investors, banks, or even smart family members. They are going to want to see that your business will grow and quickly, and that there is an exit strategy for them on the horizon during which they can make a profit. Any lender will also ask to see these numbers as well to make sure that you can repay your loan. But the most important reason to compile this financial forecast is for your own benefit, so you understand how your project or business will do. This is an ongoing living document. It should be a guide to running your business. If there is a rule of thumb when filling in the numbers in the financial section of your business plan, it is this: be realistic. There is a tremendous problem with the hockey stick forecast that projects growth as steady until it shoots up at the end like a hockey stick. Forecasts with unexplained meteoric rises in revenue really aren't credible. A note of caution: projections must be consistent with and supported by the written part of the business plan. Any difference between the written plan and the projections means instant loss of credibility and no money from potential investors. I mention this here because the pre-startup projections provide basis for building the projections in the business planning phase should the decision to move forward with the business idea be made. Because the entrepreneur's personal assets may be on the line, it is in the entrepreneur's own best interest to make reasonable assumptions and conservative estimates. So what does all this mean? The elements in the chronology of the projections. First and foremost, we need to explicitly state any and all assumptions that are being made. Then we have to create the projected balance sheet, the projected income statement, the projected statements of cash flows, and a reasonable analysis. And this is for a period from 1 to 5 years. So how much money do I really need? Well, you're going to have money for capital investment, that is, equipment and buildings, and various types of businesses will require different types of capital investment, but certainly your equipment and buildings is a way to think about starting. And then there is permanent working capital, and that's to produce goods and services at the lowest level of demand. That is, including inventory, raw materials, work in process, and finished goods, and it includes expenses, salaries, marketing programs, etc. And remember that the level of permanent working capital grows as the business grows. So the temporary working capital is also a consideration, and that is there to meet seasonal needs or peak periods, depending again upon your business. Now there's working capital management. Cash flows in a cycle into, around, and out of a business. It is the business's lifeblood, and every manager's primary task is to help keep it flowing and to use cash flow to generate profits. If a business is operating profitably, then it should, in theory, generate cash surpluses. If it doesn't generate surpluses, the business will eventually run out of cash and expire. So noting the screen that increasing accounts payable increases working capital, increasing accounts receivable decreases working capital, and we need to minimize inventory, that is raw, work in process, and finished goods, as much as possible to minimize the permanent working capital a firm is working on. Faster the business expands, the more cash it will need for working capital and investment. The cheapest and best sources of cash exist as working capital right within the business. Good management of working capital will generate cash that will help improve profits and reduce risks. Bear in mind that the cost of providing credit to customers and holding stocks can represent a substantial portion of the firm's total profits. There are two elements in the business cycle that absorb cash: inventory, that is stocks and work in progress, and receivables, that's debtors owing you money. In the main sources of cash are your payables, your creditors, and equity and loans. Each component of working capital, namely inventory, receivables, and payables, has two dimensions: time and money. So when it comes to managing working capital, time is money. If you can get money to move faster around the cycle, i.e., collect monies due from debtors more quickly, or reduce the amount of money tied up in inventory, the business will generate more cash, or it will need to borrow less money to fund the working capital. As a consequence, you could reduce the cost of bank interest, or you'll have additional free money available to support additional sales growth or investment. Similarly, if you can negotiate improved terms with suppliers, for instance, get longer credit or an increased credit limit, you can effectively create free finance to help fund future sales. It can be tempting to pay cash, if available, for fixed assets, such as computers, plant, vehicles, etc. If you do pay cash, remember that cash is no longer available for working capital. Therefore, if cash is tight, consider other ways of financing capital investment. For instance, loans, equity, leases, and that type of thing. Similarly, if you pay dividends or increase your draws on the business, these are cash outflows, and like water flowing down a drain, they remove liquidity from the business. So let's look at some financing options. First is debt financing. Debt is typically cheaper than equity. That is, long-term interest on loans is less than investment returns in the stock markets, or in this case, equity in the business. Debt offers a tax shield. Interest is deducted from earnings before taxes. So why wouldn't we always use debt financing? Because debt requires regular repayment or default, and bankruptcy or loss of collateralized assets. And lenders tend to be more conservative, which is reflected in the lower interest rate and required capital or collateral. Or, as is frequently the case, the new ventures will not lend at all. Then there's equity financing. There's inside equity, that's founders, friends, and family, and private equity. That's angels or banks and that kind of thing. Then there's venture capital. There's public offerings, the ultimate in wealth creation, as we say here, that where you go public and offer your stock. And any increase of equity beyond inside equity will often lead to dilution or the lowering of the percentage of ownership in the company, so that if you get equity financing, you will ultimately own less of the company. Conceptually, the spreadsheet is simply a representation of the original accountant's paper spreadsheet composed of finely lined pages of labeled columns and numbers. The original concept was to provide the user with a way not only to present the numbers, but to also embed the mathematical relationships between those numbers so that the implications of different assumptions could be easily and consistently prepared. Note that spreadsheet templates and help are available via the internet. It's time for questions and answers, and I have a question from the studio audience. It is, what is the difference between a pro forma financial statement and a master budget? Well, a master budget refers to a summary of the company's plans that set targets for production, expenses, sales, financing activities, and distribution. It helps a company in setting spending limits and tracking expenses. The pro forma financial statement is defined as a financial statement prepared on the basis of some assumed events and transactions that have not yet occurred, so they are in the future. Historical financial statements are used to measure an organization's past performance and condition. We have completed part 1 of step 5 of the 7-step process. These are the main topics for the next 2 sessions. Note that this series can be used for one or multiple ideas. Also note that one-on-one mentoring is available and will be helpful to get to the go, no-go decision. Please be with us for our next session, Financials Part 2, where we will answer the question, how do I construct financial projections?